And welcome once again to Investor's Edge. I'm Gary Culp. I'm your host. Hey, thanks for being with us today. Glad you're here, ladies and gentlemen. Happy that you are listening. It is 8/8/2025. Even though on a check early I put 7/8. Hey, hope you're having a good day. I hope I'm on my usual Delta flight, but the later one tonight to up to New York. We're getting the usual weather here in Central Florida. Darn it. We'll see how it goes. I think we'll get out. A couple of times I got back in New York City by 2 a.m. That's what happens when you get the weather. What can I tell you? Anyway, I'll be hanging with the dad for a couple of days this weekend. Going to be 94 October 20th. And my son Aaron's birthday tomorrow. So we're going to have a good weekend. And I hope you do too. Ladies and gentlemen, I just got to start out. As you know, we call balls and strikes here. And we never used to have to talk about them, but they interfere so much with our lives that, well, 37 trillion of debt, but I gotta kudos to the president. He pretty much has brokered a peace pact with the Azerbaijan. Amazing. Well done, sir. And I have no clue how much he's involved. All I can tell you, he's representing it. And the two leaders of the countries are together. They don't look that happy. But peace. It's a peace deal with Armenia and Azerbaijan. I think I pronounced that one right. That is freaking awesome. Kudos. Big applause to the president. Nothing more important than peace. And I got to tell you, if he's able to broker Russia and Ukraine, double applause. We segue. In case you don't know, this is serious talk on you and your money and everything that affects it. We will do the market, the economy, your job, your industry. We did Doge. We don't talk about that now because that looks over and done after the big, beautiful bill that is going to explode debt deficits and spending going forward. We'll talk tariffs. We'll talk concentration in the markets. Wait till you hear some of the things today. And whatever else comes to mind, there's time allotted on this show. And if you do not get this radio show in your city, we'll post it at GaryK.com. We'll also post it on our X feed. It'll also be on the Biz TV YouTube channel. And of course, if you'd like to email us, just be nice. We love when we get emails from people that completely disagree with us, but are respectful about it. We love that. Respect is everything. We don't suffer the doofuses, though, ladies and gentlemen. Okay, I want to start specifically with something that happened this week that is just amazing, stunning, gargantuan. We have been telling you to avoid Apple as a stock since December. Avoid. And they crumbled it into the Trump tariff crash. But it rallied up initially, but it's done nothing. Going into this week, it was an absolute horror show. And rolling over badly. And then earlier this week, the CEO, Tim Cook, has a meeting with the president. And he announces, we're going to add $100 billion to our $500 billion commitment. Now, let me explain a couple of things to you. It's bullcrap. First off, that $500 billion was already baked in the cake. They want to make Trump look good, and good on them. And the $100 billion, whatever. And I think they're going to be making some things here, but they're never going to make the whole iPhones here. That's impossible. They'll be charging $4,000 for one. But I digress. They are now completely exempt from tariffs because of all this, which, as we told you, we don't like. We don't like a president being able to threaten somebody with higher taxes, and that's what it is. If they don't do what the president wants, that's dictatorial. We said that yesterday. We don't like it. But let me just tell you the outcome. Apple was up 13.33% this week. Do you know what that represents? Get this. $400 billion in market cap. Do you know what that represents? A bigger market cap in 1 week movement for Apple than 478 stocks of the 500 S&P 500 stocks. That is unreal. They did not sell another iPhone, any iBuds, any iWatches anymore than they would have. This move was based on some sort of negotiation, contact, what have you, with the president, and get exempted. Just remember, Apple paid $800 million in the first quarter in taxes and $1.1 billion in the quarter now. There are many saying they got on bended knee to the president. That's apropos, don't you think? Think about that. This is how big some of these companies are now. A 1 week move. By the way, I take that back. A 3-day move, because it did nothing on Monday and Tuesday. A 3-day move was bigger than 478 stocks of the S&P 500. I think 478, make sure I get this right. 477 was Home Depot at Home Depot's whole market cap is $385 billion. Apple moved in 3 days more than Home Depot's market cap. Holy crap. Anyway, that helped the NASDAQ 100 this week, of course, because it is one of the big seven, and as we have told you, and these are stunning numbers. 7 stocks are almost 65% of the NASDAQ 100. But even more stunning, those same 7 are 34% plus of the S&P. Think about that. 490. By the way, go on Google and just put in S&P 500 market cap list. And you'll see like the bottom 100 are all like 0.06%. They should just get rid of 100 stocks at this point. Anyway, you know what we're going to be doing? We're going to watch the bottom 100. Because if this continues, let me tell you what happened in 99. You almost had something like this. And guess what held up best and did best the next year while the market collapsed? The bottom 100. I remember a lot of them were like the home builders. We told you, we visited the CEO of a big home builder because somebody I worked with had them as a client. And the CEO said to me, is my stock ever going to move? It's trading at 1 times earnings. Guess what? It rolled during the year 2000 to the upside while everything else crumbled. So we'll see, just letting you know. And by the way, one other note on Apple. They have now bought back $704 billion in stock over the past 10 years, which is greater than the market cap of 488 companies in the S&P 500. Yes, they generate a lot of cash. That's the story, ladies and gentlemen. Unbelievable concentration. It's not to take away from others, but I can tell you, my NASDAQ screen to my left, that does not make up the big ones, is beat red today. NASDAQ was up 207. Up next, lots more. This is the one only Investor's Edge. And welcome once again to Investor's Edge. Now, as we have explained to you in the past, if the rest of the market worsens while the select few do what, go look up the words Nifty 50 also. If we get narrower and narrower, there is always an eventuality. They're going to come after everything eventually, but I do not believe we're close to that as of yet. And as I said to you, there's been some weakening. Transport's weak, very weak. The banks starting to weaken. Something to watch very closely. Haven't gagged yet. I tell you about my left screen. It is a screen of all these companies that are not mega cap, that are small to large, that have been blasted, that used to be strong. Something like a snowflake that has just crumbled. CrowdStrike that just recently crumbled. Twilio that has crashed. That whole screen is beat red today. And a lot of them are NASDAQ. And the NASDAQ was up 207 today, and the NASDAQ 100 was up 221. Do you know why? Apple up 9, Netflix up another 33, still way off the highs, but as we said, it's starting to recover. Google was up almost 5, and guess what? That's been better. Meta was up 7, that's range bound after gapping up. Nvidia ain't doing anything wrong. Broadcom not doing anything wrong. Guess what? What's the 7? Tesla. That was up 7 today. But they got some things to deal with. Amazon is the 7th, by the way. Amazon gapped down on earnings and is holding. So going to be quite interesting going forward. We will keep in touch with you. You better be listening, because if the negative happens, you're going to need to know it, because you won't hear it from the rest. Just let you know. What else do I need to tell you about? Recently, we have been warning you about initial public offerings that are coming out at stupid prices. In other words, they do a $30 deal and they open it up at $100. And a few days later, it's $50. And if you bought in all the excitement, you're getting kicked in the teeth, like Symbol Fig. I think it was a $35 deal, opened at $90, went to $142, closed that day at $122. It's $78. 5 days later. So if you bought in all the excitement at $142 and didn't trade it, $78. I'm going to estimate that's a bit in the 40s of a loss in 5 days. Well, there's another one. And we are not telling you to buy, sell, short, or cover. We're just letting you know at the moment they do not know what the hell they're doing as far as all the IPOs and pricing them. And they're getting a little too crazy off the get-go. Symbol FLI came out yesterday, I believe around $45, hit a high of 74. First off, at 74, market cap of about $10 billion. The company loses a lot of money and doesn't have about $100 million in sales. That's 100 times sales. Stupid. Well, it hit 74 yesterday. This is yesterday. Closed at 50 today, down 10. Last I looked, 24 bucks on 74 is in the 30s. You lost if you bought at the high yesterday and held on. And by the way, this is a space and defense technology company providing mission solutions to national security, government, commercial customers. Terrific. But it closed now at a $7.5 billion market cap, approximately, with $100 million in sales, and they lose a ton of money. And they're going to be dependent on the government, which could be flaky. So we're just letting you know. There are moments in time. Remember when the SPACs came out? By the way, they're doing SPACs again. Oh, that's right. Donald and Eric Trump are now going to do a SPAC. Yay. Remember what we warned you about? The SPACs, the special purpose acquisition companies, otherwise known as blind pools. Let me explain to you. When I started in the business, I was at a penny stock firm. We did blind pools. We did them at 5 cents a share or 10 cents a share because we were a penny stock firm. We actually merged them with companies that had sales. When the SPAC started to proliferate, these scumbags started merging with a bunch of companies that had no sales and were pretty much some scams. One guy went to jail. They all told us, electric vehicle companies and battery companies, why? That way they can sell it to a public that wasn't looking. In other words, they were screwing you. Well, guess what all those SPACs did? They all crashed. And we don't want to go through that again, so we're just letting you know they're starting to come out with SPACs again. And we're letting you know we're going to watch them. And we're letting you know if the creeps start doing bad things, we're going to call them on the carpet. And I will tell you this time, we will ask them to come onto the show and defend themselves, which will get me a lot of hate. But I don't care, because I remember the crappy companies that went from whatever down to 1. I saw one guy put in jail. Another one was indicted, but I don't know what happened to him. So we are watching your you-know-whats for us and for you as we move forward. And of course, they're all going to announce the same industries. You know which industries they are? The hot ones. Because that's what con artists do. What's hot? Oh, that's hot, so let's con the people. Let's come up with a bunch of bull crap. That's what they do. So at the time, the hottest things were electric vehicles and batteries. So that's what they did. And they got themselves wealthy, and you got screwed. And we don't want that happening. So just letting you know, they're doing it again. SPACs. If I were running the SEC, I'd be all over their arses, making sure they ain't happening. Up next, what else going on? Thanks for being here. I'm Gary. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. Boy, you know what I just noticed? Cisco Systems broke to a new yearly high today on 66% better volume than average. Cisco! Wow. It's in the Dow also, but doesn't matter too much because it's lower priced than most other things. $72. Yes, that's Cisco, by the way. That hit a high in the year 2000 at $82. It is 25 years later, and it's 72. Do not forget how things change. Do not forget. I remember all the big stocks back then that you had to own. I remember Nortel, gone. Lucent, gone. America Online, merged with Time Warner, gone. Buyouts like Ascend and Newbridge Networks and all kinds of other ones, gone. Some of them bought out. We will be paying lots of attention as we move forward, because I have to tell you, this AI thing, I told you I've been studying more and more. I believe that they're overspending. I believe it's going to be big, but the numbers that they're coming up with are insane. But I started using it in the last few days. Boy, it does make a difference. I've been doing searches. Boy, it comes up a lot more specific, to the point type of thing. And I do it through whatever, I don't even know the name, what Google has. Alphabet. Why'd they change the name? So to be watched, and of import. There's a narrow group of names that are getting the money flows because AI, whether it continues or not, beats the heck out of me. But just letting you know, it be going on. But it's narrow. And I've been asked a lot of questions about a lot of stocks that have blown up. Obviously owned. Well, we have simple thought process here, ladies and gentlemen. If we own a stock and it gaps to the downside because of a worsened outlook, we get the hell out. We ask questions later. We have been lucky that we have not had any stocks gap to the downside that we have owned in almost forever. And we don't buy anything new when you get a week to 2 weeks before earnings because we're not smart enough. But we've been asked about names, and Duolingo we got asked about today because yesterday the stock gapped up. Get this. Imagine a stock closing at let me get the right number, at $343. Opens up at $468, $125, but only finishes at $390. Drops $78 from the highs and drops another 20 today. Gary, what would you have done? I would have sold yesterday. There's no way I'm writing a stock down when it hits 460 something and closes 390. That ain't me. I know, think long term. No, I don't. I watch markets. I watch stocks. I get asked about all these other names that are also been blowing up. Like, you've heard this Twilio, right? Maybe you haven't. But a lot of these computer companies, software stocks have been getting trashed. Stock was down 19% today. What would I have done? Well, first off, I wouldn't have owned it in the first place. It wasn't leading. But what do I do on a blow up like that? I'm out. I worry about it later. And that could be wrong. That could be wrong. I've seen plenty of times where stock gaps down $20 and finishes only down 10. And then rallies higher. This happens. There's nothing really baked in the cake as far as what happens during earnings season. We just have simple rules that we follow very carefully. And all the rules are about one thing: mitigating, notice the big word, big losses. We never want big losses. And man, oh man, in spite of new yearly highs, there's 104 new yearly lows on the NASDAQ today, with it up 207. The Dow was up 206. There were still 72 new lows on the NYSE. What does that tell you? GoDaddy, you've heard of them, right? They keep raising my what I pay them. Stock was 216 in January, the yearly high. It's 133 today. Down 11%, by the way, on their earnings report. We're just letting you know there's a lot of that going on. And as I said, my left screen that has a lot of these names beat red today with a good index day, which tells you again, very narrow. The Russell 2000 was hardly up today, and the mid-caps were down today. And then you have things that gap up and then give you a certain finger. Yesterday, Dutch Brothers, the coffee company, which I hear they're pretty good, gapped up big. At one point was $73. It's 66 today. If you bought 73, you're down 10% already in a day. That's why we're very careful around earnings season. Especially now, because you are getting whipped around like there is no tomorrow. And then there are others. Something like an Oracle that gaps up and moves and has another big day, a second day, that usually tells you institutions are piling in. Guess what Oracle did afterwards? Boom, it kept going. You know what's doing that now? Maybe Reddit. Had 2 strong days off of earnings. But then you have others that do the opposite. Or a Meta, which gapped up and is now sitting for about 6 days, which is excellent. We like that. We like secondary places to buy. And how do you find them? You gap up, you get too extended, you make a right turn, you draw a line over the high, and then you break above the high. There you go, another move. That's what we look for. So most of the questions we get on stocks are usually stocks that have been blasted. Interesting, huh? Why? Protection of capital. Muy importante. Now, I got 10 emails on Apple today. What do you think? Oh, I wish I bought it 2 days ago. The high was 260 in December. It closed at 229 today. And that's after being up $27 this week. Insane, huh? Growth is slow and slower. And I wonder, the next big thing is a flip phone. You going to buy a flip phone for $2,000? I'm not. I thought we left the flip phone a long time ago. I could be wrong. We'll see. Anyway, as I said, on Apple, I'm stunned. A visit to the White House, exemptions, gets you $400 billion of extra market cap. That rule we don't make. And I don't think there's a pamphlet on that one. And I want to repeat again, and I want you to remember this. We are the most concentrated ever. They are to be watched closely. And even more, we're underneath the surface watched closely, because if we get to the point where I say to you, 70% of the stocks are now in downtrends, but the indices are only 2% off their highs because of these 15 names, we're getting close to heck. That's how it works. The market likes deceiving. And most people that don't go through the innards get deceived. We won't. Up next, take you to the weekend. I'm Gary. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. May I add a couple of other lessons? I noticed today that Under Armour was down $1.20 or 18% to $5.44 on a worsening outlook. And then I went to the monthly chart on Under Armour and noticed in 2015, Under Armour hit an all-time high at $54.70. which means it's down 90% since 2015. That's Under Armour. Nike, which has been much stronger than Under Armour by far, and has had a big run through many years, but hit a high of 179 in 22, just recently bottomed at around 53 and closed at 74. It's trading where it traded back in 2017, 8 years of no gains, and its sales the last 4 quarters were down 10% over the last year before that, and earnings have just crumbled to a down 86% year over year. Now the stock has been a little bit better because I guess they cut some deal with Amazon or something. But this is what we mean by lessons and following stocks. And I know you're always hearing from the pundits, think long term, but that should be if you own maybe the S&P or things like that. I'm letting you know on an individual basis, we are investing in companies. The stocks represent those companies. And the market basically will place a price on those companies. And sometimes it gets out of hand to the upside. Sometimes it's insane, the no sales crap. And then sometimes and oftentimes, the market has its way of telegraphing trouble. And both these stocks started going wrong before the bad news started coming out. And once bad news happens in corporate America, sometimes it feeds on itself. And then you're destroyed. I just want to bring that up because I didn't realize Under Armour. I haven't looked at this. It's been off my screen forever. I didn't realize that sucker was down to $5. I'm pretty sure I've seen it, but didn't pay attention to it because obviously it's going the wrong way. So just keep these things in mind. And I'm bringing this up now because, and talking about it more because in the last 3 weeks, we picked up accounts with 200 stocks in them. And as I was going through those 200 stocks, I was just amazed how many were in protracted downtrends. Not down 10%, not down 20%, but in major bear markets where the companies are doing poorly. And what these people were told were, well, we want to own a piece of that industry. What? We want to diversify into all industries. Well, why would you do that? You know what the worst acting group in the market's been for a very long time that doesn't get talked about anymore? Marijuana. Well, the good news is I don't think anybody's diversifying into marijuana. But I'm making a point. Why would you own big downtrends, bad companies? I don't want to mention what companies they were, but there were some things in there where the companies announced big trouble. Slowing sales, shutting of stores. You ever want to know what not to own? Any retailer that's shutting stores. Anyhow, just part of the lessons that we've learned that we want to teach to you. Because imagine if that 200 stock list were all in uptrends or in the leading groups and not in what have you. One of them, by the way, had Chipotle, which topped out at 70 bucks in 24. It's 41, and they still own it. And they asked, well, it's Chipotle, and they've had a good rep, but they're no longer growing like they used to. Tremendous competition. No changes. So just keep all this in mind. That is why we break the markets apart for you here. That is why we talk about sectors. Not own this. One of our great calls of the last year was telling you to avoid the HMOs and the managed care. They're down 50, 60%. United Health, 606 to 250. That's what we want to do. And when we say to you, we're never going to own something like that, it's for a damn good reason. We want I-95 North, not I-95 South. And when we tell you we avoid the no sales, we miss the upside. We miss the crashes. Just the rules we follow. That all said, have a great weekend. Head into the airport. Drive carefully. When you get home, do like we do. Make sure you hug your family. Make sure you hug your children. They will feel better. You will feel better. I promise. Stay well. Be well. Thanks for joining. Good night, all. Bye-bye.